The global financial system was not created so people could trade stocks on their phones. That's a side effect. The real reason it exists is much simpler. Modern economies need a way to move money through time. Most of the things that really matter do not happen today. For instance, hospitals are built now and used for decades. Pensions are paid long after someone stops working. Insurance premiums are collected today for claims that may not happen for 20 or even 30 years. But without a system to carry money forward through time, none of this really works. So the financial system exists to solve this problem. At its heart, it takes savings set aside today and puts them to work so they can fund tomorrow, next year, or the next generation. This is not gambling money. This is pension money, insurance money, household savings, government money. It is long-term capital trusted to the system with a job to do. For the system to work, it has to achieve three things at the same time. It has to help money grow over long periods. It has to provide stability and income so promises can be kept. And it has to stay flexible so money can move when conditions change. So, growth, stability, and flexibility. These are not nice extras. They are structural requirements for the system to work. A system focused only on growth could collapse during crises. A system focused only on safety would slowly grind the economy to halt. A system with no flexibility would freeze when the world changes. No single investment can do all three. So instead of one solution, the system evolved into a structure. Different parts exist to do different jobs. That is why finance can't be understood by looking at one product in isolation. A stock, a bond, a property, on their own, they tell you very little. They only make sense when you see how they fit into the larger machine. And that machine is enormous. Public stock markets around the world are worth roughly $100 trillion. That figure represents ownership in thousands of companies across every major economy. But stocks are only half the story. Global lending markets are at least as large. Government bonds, corporate bonds, mortgages, and other forms of lending also exceed $100 trillion. So at a system level, ownership and lending sit side by side in similar size. That alone challenges a common belief. The financial system is not dominated by stocks only. It is balanced between growth capital and contractual capital. Now add private businesses. Many of the world's largest and most profitable companies are not listed on stock exchanges at all. When you include private equity alongside public equity, total global ownership rises even further. Then there is cash. Governments, companies, banks, and households hold tens of trillions in cash globally. This money is not idle. It is waiting to be used, moved, or deployed when needed. And finally, there are physical assets, property, infrastructure, commodities, and precious metals, which represent some of the largest stores of wealth on this planet. When you step back and look at all of this together, something becomes obvious. The system is not built for excitement. It is built for endurance. At this scale, capital is not trying to make a quick win. It is trying to survive across decades. Pensions must be paid long into the future. Insurance firms must withstand extreme scenarios. Governments must fund services through good times and bad. That is why the system is diversified by design. Not diversified as in lots of things. Diversified in function. Different pools of money exist to do different jobs. Some money must grow, some money must be dependable, some money must remain liquid, some money must protect against specific risks. No single asset class could carry all of that weight. So the system evolved into four core pillars. Let's start with the first: lending. Lending is the oldest part of finance. Long before stock markets existed, people lent money. Lending exists because large projects need funding today to deliver benefits far into the future. When a government builds a hospital, it serves people for decades. When a company builds a factory, the payoff arrives gradually. When infrastructure is built, its value spans generations. Lending makes that possible. At its simplest, lending is a contract. Money is provided now, interest is paid along the way, the original amount is returned at a known date. That certainty is the key feature. Globally, lending markets exceed $100 trillion because borrowing is embedded in modern life. Governments borrow to manage spending, companies borrow to grow without giving up ownership, households borrow to buy homes and fund education. Lending allows planning. It allows institutions to match future obligations with predictable cash flows. For pensions and insurers, this predictability is essential. They are not chasing excitement. They need reliability. This is why lending stabilizes the system, and it behaves differently from ownership. When economic growth slows down and uncertainty rises, high-quality lending often becomes more valuable. Why? Because certainty itself becomes valuable. This is why high-quality lending often holds up when equities struggle, not because it is better, but because it is designed for a different job. Lending provides the floor. With that foundation in place, the system can accept risk elsewhere, which brings us to the next pillar: ownership. Ownership exists because lending alone cannot drive progress. Lending offers certainty, but it caps outcomes. Ownership allows participation in what is created. If you own a business, your return is not fixed. You share in success and failure. That uncertainty is not a flaw, it is the cost of growth. Ownership exists in two forms: public ownership through stock markets and private ownership through businesses not listed on exchanges. Together, they represent ownership in productive capacity of the global economy. Prices move because expectations about future profits change. That movement is called volatility. Volatility doesn't mean something is broken. It means the future is uncertain. Over long periods, ownership has been the primary engine of real wealth creation, not because it is stable, but because it compounds. This is why ownership can't replace lending, and lending can't replace ownership. Each pillar accepts a different role, but growth and stability alone aren't enough, which brings us to the third pillar, which is cash. Cash looks unproductive, but it performs a critical function: liquidity. Liquidity means the ability to move money immediately without loss. Cash allows payments to settle, bills to be paid, systems to keep functioning. Without liquidity, even healthy systems freeze. This is why every institution holds cash, not to earn returns, but to maintain flexibility. Cash creates optionality, time to respond instead of react, time to adjust when conditions change. Cash is not a growth engine, it is the system's escape route. And finally, the fourth pillar: alternatives. Alternatives exist because not all risks come from the markets. Some come from inflation, some come from scarcity, some from physical world. Property, infrastructure, commodities, and precious metals behave differently because they are driven by different forces. Rent, usage, scarcity, real estate tied to the real economy. This introduces an essential idea: correlation. Correlation describes how assets move relative to each other. If everything moves together, diversification disappears. Alternatives matter because they often respond to different pressures than stocks and bonds. That difference is the point. They do not replace other pillars, they support them. Together, the structure becomes quite clear. Lending provides certainty, ownership provides growth, cash provides mobility, and alternatives provide resilience. At this level, it's not about predicting the markets. Institutions are not asking what will outperform next year. They are asking whether the system holds up across many futures. That is why the global financial system endures. It adapts, but it doesn't improvise. Once you see the structure, finance stops feeling random. You stop guessing, you start understanding how the system is built to last. If this helps you see how the global financial system actually works, consider subscribing, and I'll see you in the next video. All the best.